Hey guys, welcome back again. So basically, in this section, we're gonna be talking about indicators. So in terms of indicators, we are very choosy. We don't use every indicator that we come across. No, we use only specific indicators and for specific purposes only. Otherwise, we use what we know, which are market maker cycles, and then what else? Technicals and fundamentals. So, but then in terms of indicators, the indicators that we use are not custom. They no, actually they are custom. They come with the market makers template. So there are no other external indicators that we put inside our charts, except the tools that comes with the MetaTrader, which are the Fibonacci and the what do you call it? The shapes, which is the triangle, the rectangle, and the and everything else that comes with MetaTrader, basically the tools that you know what I'm talking about. So the most important moving average, moving actually indicators that we're gonna focus at, it's exponential moving averages, it's the TDI, the ATR, and then the work time. I call it the work time no auto GMT. That's one. It comes with the market makers template. It's an intraday trading session indicator. Shows you when it throws when the London session is in play, stop hands at the Asian session and the New York session. So otherwise, without wasting any time, let's get right into it. Going to moving averages. So basically, we use moving averages as dynamic support and resistance. I'm gonna assume that you understand when I'm talking about dynamic support and resistance. I'm talking about the moving support and resistance, because moving averages they're not fixed. They tend to move along with price. As price goes up, they go with it depending of what number the moving average is. So we use different moving averages for different purposes, but then we use them, number one, for dynamic support and resistance, because moving averages moves along with price, whether it's going up or it's going down. Secondly, we use moving averages as entries and exits. We call that moving average bounces. And then thirdly, confirmation of trend direction. You look at certain moving averages, where they pointing, which crossovers do we see on the charts, on what time frame, and then that concludes where the direction of the trend is. Maybe regardless of whether it's short term or long term, you'll just look at the certain time frame and look at those moving averages, whether they've crossed over, and then how do we see bounces, which moving average is moving really close to price, and so forth. So we can confirm where the trend is going, whether it's bullish or bearish, just looking at moving averages. You can also use moving averages for level count for certain crossovers. We know when you have 15 to 100 moving average crossover, we call that, we might refer to that as level 1 crossover, maybe from anchor point, which could be the highest uh, price or the lowest price of the week or month. From that point, if you get 50 to 100, that's a level 1 crossover, and then 200 and 800 is level 2 crossover. So, but I'm gonna show them to you properly. And we also, what we have, a systematic moving average crossover in time frames. So, like for instance, you should know when you see a specific moving average uh, on certain time frame, you know immediately there's another moving average at another time frame. I hope that does not making sense. Okay, let me just go to my charts and show you what I'm talking about. But then the most important thing that we're gonna focus on right now, it's moving exponential moving averages, and then as we proceed, we're gonna incorporate in Fibonacci, then TDI, and then lastly ATR, and then the work time noted GMT indicator. So without wasting no time, let's go to our charts there. Uh, Actually, I had some things open here. Yeah, because remember, we're only gonna look at intra-week cycles. I don't wanna look at. I don't like looking at very small uh, cycles. For me, it's like looking at a microscopic vision of something. No, no, no. It's either you go big or you go home. We wanna enter here and then exit there. So first things first, I wanna show you a systematic moving average crossover, and how you can be able to re-enter and then look at it, looking at just moving averages, nothing else but just moving averages. And then remember, when you look at moving averages, you wanna look at them from your highest possible point, which is the Tuesday, Wednesday stop hunt, or the Thursday, Friday reversal. You understand? From any high point, that's when you start looking at your moving averages, whether it's crossovers or not. So, uh, I want to look at a yeah. Let's look at this one. I think this is a perfect example, because I want to show you a very ideal setup so that you can be able make sure that you'll be able to find the variations of the same theme on other flashcards or other currencies. So systematic moving average crossover, because let me just go back there real quick. I want to show you, we talked about 3, 13, 50, 200, and 800 moving average crossovers. So let me just go back. There they are. It's the mustard, the ketchup, the aqua, mayo, and blueberry. So 3, it's mustard. 13, it's ketchup. 50, it's aqua. 200, it's mayo. And then 800, it's blueberry. So let's get it right into it. Where's that? So there we go. So we're just gonna look at the moving averages, systematic moving average crossover. As you can see, this is the highest point of this chart. So when was this? This was the 5th. So this was Friday the 2nd, and then Monday the 5th, Tuesday, Wednesday. So it was Tuesday, Wednesday, stop hand. So this is a Tuesday, Wednesday, stop hand. So I'm just gonna draw a little something there, just to demonstrate my point. So that's a weekly cycle right there. Just gonna draw my Monday, which is the accumulation phase. There we go. We have Monday as accumulation, Tuesday, Wednesday stop hand. What time was that? Uh, it was between. It was just after midday, so it was London session, not New York Open or London Open. It was during the London session when this happened. So it's okay. Otherwise, when knowing your moving averages, knowing that this occurred, it's a Tuesday stop and high. So for you to be able to have that conviction of taking this position shot, you should first the 3 and 13 moving average crossover as 3 and 13. So let me just do that. Let me just type it real quick. It's gonna be 3 and 13 EMA crossover. Let me just change the color into white. Okay, let me just do that. Yeah, there we go. I'm also gonna go get the eclipse. That is our first moving average crossover, ladies and gentlemen. Just gonna change that into black color, then remove the background. Also increase the thickness to level 2, and there we go. That is our first crossover. The second crossover, it's 13 and 50. 3 and 13, 13 and 50. Just gonna copy and paste that here. 13 and 50. There we go. From 13 and 50, we're gonna go to 15 200. There it is. That is the 15 200 EMA crossover right there. Let me just put that over there. And then lastly, the 200 and the 800 moving average crossover. It's like a story. They tell you something. You just need to be able to read it. So when you're able to read the story that the moving averages are trying to tell you, then you're gonna be profitable. That's one thing for sure. So you don't just want to know a little bit of something. You need to know it and master it. So, oh, I'm sorry about that. So basically, what I know, it's everything that I master. I don't. If ever I know something, I have to master it. I can't just know it partially, you understand? So those are the systematic moving average crossover. The first moving average crossover is 330, the mayo and the ketchup, and then there comes the ketchup and the aqua, and then the aqua and the mayo, and then the mayo and the blueberry. So it's 3 and 13, 13 and 50, 50 and 200, 200 and 800. It says a story here. So after when you see this as the 50, because the first moving average is 3 and 13. So if I'm on 15 minutes time frame, before I make an entry, I need to see 3 and 13 crossover first. Because this was before, this was maybe, if ever this is London Open, let me just put that in. It's not London Open actually, it's during the London session. Oh, actually, it is the New York Open. So those highs that were formed during the London session, but then when the New York Open, when the appropriate, precise time, entry time, New York Open, it gave us a little retest there, support and resistance. So that was our, actually this is a very good entry, because you know how we got a crossover there after we got that bearish engulfing candlestick, and then what the price did, it came back, it came down and came back and retested that area. Actually, it came back and retested that moving average crossover price came down, came back to retest that 13 moving average crossover. So this was a very good entry. You see that you enter, and then you see another crossover trend 13 and 50, you re-enter again. You see 250 and 200, you re-enter again right here. You see 200 and 800, you enter south here again, you go south because it's in line with the trend. But then because this was let me see, when was this? I think this was Friday. One, two, three, four, five. Yeah, I think this. Yeah. So because this was Friday, we were expecting a kind of like a little reversal, but then honestly, I don't like counter trading. So instead of buying it, I would just wait for a very good retracement. Like for instance, let me just wait my Fibonacci here. I would just wait for like 50% retracement, and then the price should come back and retest that moving average there, that crossover there. The same thing that's happened on the 3 and 30. So going back to the roll chart. So otherwise, this is what I wanted to show you. But then the other most important thing that I want you to be careful about, it's the crossovers. You shouldn't get eluded. So in terms of levels, the this is the first level crossover. 15200. This level one crossover. So if I get this thing from the anchor point Tuesday, Wednesday stop hunt, and then I get a moving up at 15200 moving average crossover, I know that's a level one safety trade. So if ever I had taken a position, I wouldn't take a stop and low here. I'd rather take a stop and high because I've already got a crossover. So I would wait for something like this. Then it issues me that I take it, and then price moves 30 pips. I break even. If it comes back like that again, I already have some kind of pending orders on those highs there, because I know it's a very high probability area, and then if ever price comes around those areas, it's not gonna stay there for too long because we already have a crossover. It's just gonna give us, that case of the devil, and then it will just fall like that. So you should know that. And then 15 to 100, that's level one, level two crossover. So right now we know this level two, so we might just wait for price retracement, like that 50% retracement to that level there, because it's Friday. We expect a midweek reversal, and then maybe later during that day or Monday, I don't know, then we might get another opportunity of selling. And then the other thing, before you could make sure that you see everything. Like I prefer drawing my trend lines as well, so that's what I would also do. Zone them out like that, and then look at taking a short position within these areas. Given also that there's also 15 200 moving average there, so it might give us some kind of a bounce. I would also look at support and resistance. Let me just draw a horizontal line there. What do I have there? So I also have that. So this is my previous support, which might potentially uh, turn into resistance, and then which might give me a good entry opportunity going south. Let me just change that into a pink color, and then also remove that the no auto GMT indicator there. So now you can see what I'm talking about. So if ever I'm gonna take a short position, it needs to be well within my criteria, things that I've set for myself for me to be able to take a good position. This things needs to be, my criteria needs to be completed if ever I'm putting it properly. But then, for me to take a shot position, it needs to be around these areas. So basically, I have two possible areas that I might be interested in taking a shot position. It's either from, remember, we're just looking at moving averages. We're not looking at anything and then anything else. But then the other thing is that we cannot ignore subprime resistance because there it is right there. So we're just gonna look at it and also try to incorporate as to how we can be able to take a short position with the confluence of that. So this is the areas that I might be able that might I might feel very comfortable in taking short positions. So let me just change that into a red color, and then so I basically have two possible locations where pride might reverse. So that's it, ladies and gentlemen. It's in line with the trend. It's Fibonacci retracements right there. Let me just do that. It's 38% Fibonacci retracement. 38%, anything between this 50 and 618, it's a good one for me because there's also major apparent resistance and there's also moving averages there. So it's also in line with the trend. So from anchor point level 1, this anchor point level 1 safety trade, because why, there's a 208 15 200 moving average crossover there, then price comes below, it has to come back and retest that same subparent resistance and then retest that moving average is there. uh, and then the other thing you should know that, nah, there's a trick that I want to show you. You see how this thing here is on 15 minutes, and then I'm anticipating, I would love the price to come and retest this 800 moving average on 15 minutes. You know why? Because I know if I have 800 moving average on 15 minutes at a high value area, I'm gonna look at 1 hour. At 1 hour, there should be this 200 should be around the same area there on where there is 800 on 1 hour. So let's go to 1 hour. Okay, my chart is not updated yet. Oh, but actually it is. So as you can see, it didn't come back there. But then we knew that if ever price came back to that level there, we were supposed to have taken a short position because it came to that 200 moving average crossover on 1 hour. 15 minutes, on 15 minutes, it's 800. There it is, 800 there. Let me just put an arrow pointing it going south. Let me just change the size of that. So this is the point here where the 800 moving averages move 800 moving averages on 15 minutes is gonna converge with the actual candlesticks of the price. So which will give us 800 on 15 minutes is going to be 200 on 1 hour. There it is. And then 50 on 4 hours. Where is it? Let me just zoom it all in. And there it is. Do you see that? So there's a confluence of moving averages. If ever the price came to this area, with no doubt I wouldn't have thought twice about selling it. I would enter into a position because it's a proven system. It's something that is proven to be working. So let me just go back to those pictures so that I can demonstrate further what I was trying to show you. So there's those moving average crossover, the 3 and 13, the 3 and 13, and then the 13 and 50, 15 200, and then obviously 800 200 and 800 afterwards. So after just saying this, you can safely take a position here even if it's a very big move, it's a price burst from those lows there. Like market makers, they had enough, so they had already collected more than what they had wanted, so they just burst, like they just run away very quick. So you can also take this position because you got that not the W triple bottom there, if I can call it that, and then it's a Tuesday, Wednesday stop, and there's a major support area, and then it's potentially low price of day, low price of week, and low price of month. Because you know why? There's the second week of the month. You understand? So if the second week of the month, this area could potentially be the lowest price of the week, and there's the lowest price of the month. So after having this trend moving average crossover, you enter into a position just after seeing it, and then remember, this is 30 minutes. Remember, if ever this crossover we say it, here on 30 minutes, which means that it happened somewhere here on 15 minutes. So whatever that you see on 30 minutes or on 1 hour, it happened on a micro scale on 15 minutes. So before it goes to 30 minutes, it happened on 30 minutes. Before it goes on 1 hour, it happened on 30 minutes. Before it goes on 4 hours, it happened on 1 hour. You understand? It's fractals, everything, levels within levels, time frames within time frames. Everything it repeats itself. You understand? So I hope that is not confusing. It's a systematic moving averages crossover, ladies and gentlemen. This is a level one safety trade. From here, we can even though there is no visible level here, but by just having this 15 200 moving average crossover, we can conclude that price is not coming back to this areas here because it's logged. This is a level one log, so which means whatever that's gonna happen is level one retracement. Then it's gonna go to level two. So this whatever wherever price retraces from this level, it's a log. It's not coming back. It's only going up. Secondly, there is here again the 50, the 3 and 13, 13 and 50, 50 and 200, and lastly because it's going up the 200 and 800. But because we're not sure, remember 200 and 800. It's when we start looking at 200 and 800 moving average crossover, that's when we're looking at a little bigger scale. But then you could just focus on 3 and 13 for like your entries on 15 minutes, and then 15 200 for okay, this is the first one, 3 and 13 for first entries, and then second entries 50 3 and 13 and 50, and then third entries 15 200. Understand? There we go again. 3 and 13, 13 and 50, 15 200, and then lastly 200 and 800. It's a systematic moving average crossover. After Tuesday and Wednesday, because I don't have the patience of waiting for price to confirm that it's gonna go down, but other people have that patience. Like for instance, in this case, this is some kind. This is what do we call that? Is it a spinning top? It's a spinning top type of candlestick because it has a body and the head pin at the top and the bottom, and then you have a bearish a bearish engulfing, yeah, bearish engulfing candlestick. So for some people that's a confirmation. So after we get this bearish engulfing, and then the immediately we also get a 3 and 13 moving average crossover. That's the first moving average crossover starting from 15 minutes, 30 minutes. So that's another entry confirmation. You take a position without doubt, knowing that it's from Tuesday's top hand. And then remember, look at it here. This is potentially the highest price of week and month. It's HOD, HOW, HOM. This price here, and it's also Tuesday. So it's a very good high probability setup. It goes down. This level one safety trade. Like I said, from the anchor point, the highest point, we get 15 200. It's a level one. So when you see 15 200 after from the highest point of the week or the lowest point of the week or the highest point of the month or the lowest point of the month, you know that's a level one safety trade. It goes below, and then you are like it's a level one safety trade, level two. I would consider this as just level two. So it's level one correction, level two, level three. Actually it's 3 days. It's 3 levels in 4 days. It's anchor point, level one safety two. This low is lower than this low, so it's a very good level. Level two, and then a range. It ranges. This is the highest price of the day, so that's the reversal, and then it's level three. So anchor point level one safety trade, level two. I'm not gonna say that's a level two safety trade, but then it's a good entry area, taking it short. So the other thing I'm gonna tell you, I don't like in putting a lot of emphasis on levels because they are a little bit insignificant. Like they are what's the word? Inconsistent. They're not like the cycle. Sometimes you'll get 3 levels in 2 days, or a perfect three levels in 3 days. Sometimes you're gonna get 4 levels in 3 days. Sometimes three levels in 2 days. It's you just need to have the variations. The variations, then you'll be alright. So because of it already crossed over 15200 moving average cross over here, I already knew I'm buying on Tuesday. So when it gives me that this inverse head and shoulders here, I take it and I kill it. So it gave me 15200 moving average crossover, and then I know it's going up because this was the lowest price of the day, and then it could potentially be the lowest price of the week. But waiting for Tuesday, I know the price might just and give us a pin there and issues give us a low price of the week on this day. So I'm gonna wait for a possible good entry. So after even noticing that the price is, moving along this moving averages here, especially this 200 moving average. I love the 200 moving average. It's always been good to me. So I started doing my thing. 13 moving average crossover. It's a buy. The 13 and 50, another buy. 15 200. It's a level one log, level two log. 15 200, 200 and 800. After when I see this, I don't play. You don't always get 15 to 200 and 800. When it comes, you kill it. Do you see how good how good this crossovers are? You get everything like this, then you know it's gonna be a good sell. So when you get something like this, you just wait for a good re-entry opportunity, and then you know it's a sell. You understand? So moving averages, the they're on point. It's just that you don't want to use them only by themselves. You need to use them in confluence with some things else. You understand? Then otherwise will be okay. This is a kill for me. That's why I'm telling you I'm able to enter right here. So this was a good sell for me. Even this one here. So remember, use your moving averages as targets, dynamic support and resistance. You see how this is resistance. It's like price gave us an inside structure stop and high, came back below here. Price showed us a crossover, this signifying a level one crossover. It gave us a nice retest there, which is on support. This is a previous support, and then now it gave us resistance there. You see how much moving average is a word. What's the word? Let me just go back to the slides there. It's dynamic support and resistance. It's dynamic because it moves with price. When the price goes up, then the moving average follows them behind. So there we go. So it did exactly that. Where we see the same behavior happening again. There it is again. There it is. Support and resistance. This is a very good one. So you could have been able to take a position right here, and then let's see what else. Okay, let me close this one. Go, just go back there. And then let's look at gold, because gold is also nice, and I know a lot of people enjoy gold. So this is what we call whiplash. Is it whiplash? I'm not sure. So there we are. Trend 30, 30 and 50, 50 and 200, and then price really. That's a bounce there. That's support from support. That moving average. That's a bounce. That 800 moving average. There we go again. Support resistance. First crossover, second, third crossover, and then bounce. First crossover again, second crossover. Obviously, it's gonna be another third crossover, bounce. Thursday midweek, Friday midweek reversal. After one, two levels of drop in one, two, three, four. You see how levels are inconsistent, but then by just knowing Thursday, Friday, you're expecting a reversal. You do get moving averages. You do get levels. You do get support and resistance. You do get trend lines. Then you're good to go. There's a very good bounce there as well. That's a very good bounce there as well. It's a good entry. Another entry here. Remember, right now we're only looking at moving averages. 3, 18, 50, like this systematic moving average crossover and levels. It's working, guys. You just need to be consistent, know what you're looking at. Tuesday, Wednesday, stop hunt. The first moving average after stop hunt is 313. So if you like waiting for confirmations, right after this candlestick, this evening star, and then spinning tops, and then information high, tap out, it's perfect. You take it, and then when you see this 313, after having noticing this, and you remember you were able to enter here around those highs there. So after, even when you see this, you still re-enter. You don't smile with market makers and make them your friends. You milk them dry. So you entered small lots here because you were not sure, and then you have not seen the confirmations that the trend is actually reversing. But after having noticing this, you open furthermore five more standard lot positions. Then you let it run. You see this again, you don't close that. You re-enter again because right now you've broken even, and then you've eliminated the risk. So you own free trades. You see, come in like this again. If ever you have that time to look at it at that time, because we're sleeping in South Africa, it's around 3 a.m. in the morning. You take that position again. That's a level 1 safety trade. You understand? You take it again, put 10 standard loss there, 10 standard loss, let it run, break even, let it run. It comes back here. You see that New York Open. This, trust me, this was New York Open between half past 2 and 4. You see this pin. You take a short position again. Put 10 standard loss furthermore. It's a confirmed lock. It goes down. You kill it. You break down. You break even and let it run. Friday, you see that you re-enter again. Right now you maximize because you know this is the last move of the day. You understand? Last move of the day, that 15. After crossover, 15, 200 moving average crossover, price goes down and then coming back and retesting that same 200 moving average, 200 moving average. That's a good, reason for me to take very good position sizes. So yeah, that's it, guys. I think this is very clear. There's another bounce there. Uh, what else do we have? Obviously, Tuesday, Wednesday, stop and high, 3 and 13 moving average crossover, 13 and 50, 50 and 200, obviously going down, 200 and 800. So let's just look at another ones. Before, let me just go to the flashcards. Make sure we've covered the dynamic moving averages as dynamic support and resistance. We also did moving averages, entries, exits. I don't like exiting, out of positions because I'm a position trader. I'm a swing trader, position trader that trades in line with the trend. So I know a trend can go in the same direction for like 4, 5, 6, 7 months. So if I'm in a position and then I got it at a very low price at a very good entry area, well, I'm just gonna let it run. I will I will close those positions manually if I feel that the price is about to reverse, or maybe I will get stopped out on booking profit or on break even. But then if the price doesn't take me out on those first initial moments after opening the position, I'm not closing anything until I actually break even. So I've shown you confirmation of trend direction. No, I haven't gone to that. Came to that level count, systematic moving average, crossovers, and time frames. So I think we've covered this one because I've shown you if you see a 100 moving average on 15 minutes, then you already know on 1 hour it's 200 and on 4 hours it's 800. You understand? And then oppositely, when you see 800 you see uh, 15 moving average on 4 hours, then you know on 1 hour there's 200 and on 15 minutes there's 800. So that's how we go about systematic moving average crossovers and time frames. So level counts, I've covered that between, when you see 15 200 moving average crossover, that's a level 1 safety trade. And then when you see 200 and 800, that's 200, that's level 2 safety trade. Confirmation of trend direction, let's get into that. For me to be able to see the trend direction, I want to see 15 200 moving average crossover. I look at this crossover, I know it's going up. And remember, right now we're on 30 minutes, so let's go to 15 minutes. 15 minutes, this crossover is a little bit below. So let me just 15 minutes. There we go, as you can see. I'm gonna wait for another crossover going down before I enter, before I think of going short. So right now it's confirmed, trend 18 level 1. Gonna go up, another crossover going up, it's okay. Until I get this, another 15 200, then I change. That's when I change my bias right now. You understand? But then for me, the first moving average is 30, 15 200, and then the last is again 15 200 to signify that the trend has changed direction. Let me look at another pair. Let me remove there because when your chart is looking like this, it's not neat. So I prefer to remove everything and then just put them back whenever I want to use them. You see how this crossed here, 15 200 went up until it crosses again. I'm still gonna take it north. So now right now it's crossed again. I know it's going south. The same thing again. We had 50 and 200. It's not just 15 200. It's everything here. 50 50 is 3 13 is 3 13 50 200 and 800 all at the same time. So there's a very huge moving average crossover. Let me just outline that for you. It's a huge one. So I know from this point onwards, I want to take short positions only. So I wait for this. When I see it, I take it down again. It goes down. I wait for this. It comes. I see it. I take it down again. I know until I get another 250, 50 and 200 crossing over to the opposite direction, then I'm still going south. And not only that, because remember, I'm still looking at my trend lines. I have my trend lines there, and then I haven't got it close, uh, break and close above. Until I get a break and close above my trend line, then I'm still going the same direction, which is south. So I'm gonna wait for this. So after I get this, I'm gonna start thinking, yeah, maybe it might actually be time for trend reversal. But then I look for trend 50 and 200. They've crossed over. Now we're going low. Then I leave it. I wait for a re-entry opportunity. Previous support and resistance. I'm gonna outline that. Okay, there's my previous support. I want to see that becoming my previous resistance, becoming new support. So do that. This is how technicals meet market makers. Let me just change that to long green color. So in this area, this is where I'll be interested in taking long positions only. You understand? Because why the price might just come back after having breaking out like that. I let's say it's not like I'm not sure what's gonna happen from here. Because already price is broken above that you see how I draw my trend lines. It's like a zone. It's not just one line. It's a zone. I've zoned my trend line here. So after this 15, 50 and 200 moving average crossover, and then having broken and closing above that trend line, I know I'm going up. So when I see this, I know that people that we are gonna take it short here. So just to be on the safe side, I would rather wait for a breakout because everyone that sold here, you see the how prices accumulated. People were putting stop loss above those highs there. So I would rather wait for them to get stopped out and price come back to retest again, and then I know I'm gonna have my positions here. I'm gonna fill them right here, or if ever I don't, because I know the price is already confirmed that it's going up. I'll just enter. It's okay. You can enter here when the price is going, but this is like coming in late and like chasing the price. And remember, we don't like chasing price. So let me go to another one real quick so that I can conclude this moving averages and move to another things. So as you can see, moving average 15 200. You're gonna let it go up. After you see this, that you start closing. You close, and then you wait again. You see this, take it up again. You see this, you close again. You wait. You see this. When you see them crossing like that again, all at the same time, you take another long position. It's gonna go up. I'm telling you. And then remember, right now we're just looking at moving averages, and remember, you can just take a position because you've seen moving averages crossing over or bouncing. You need a lot of things, but then because already, for me personally, I already have that in my head, so it's not a problem for me when I see the. I can also trade without analyzing or drawing anything. It's just they call that naked chart or naked forex. I don't know, but then I've met a lot of people that do that. I was like, how do you do that without even analyzing? So it's people that are consistent. They've been doing the same thing over and over and over and over. Like they can just see it in like it's in like if you can't see it in hindsight, you're not gonna see it in foresight. So when you've studied them, then you mastered them. You will already say without even I know for sure. Let me just prove to you something real quick. Uh, I can tell you this is 38 to 50% retracement. From here, and then remember after this break not break above this or crossover. From this low, this is 50% retracement. From this low, this is the 8.2. You know why? Because I know I've done this multiple times. The 8.2 from that low, this the 8.2. From this low, this is 50%. Actually 58 uh 618. But you guess my I guess you get my point. So when you've done one thing for over and over a long time, you'll be able to see it even when everyone is trying to whip up their Fibonacci's and whatnot. When I already understand, oh, okay, that's how it is. So in terms of let's go back to our slides. I believe that I've covered everything we need to know about exponential moving averages. And the nice thing, ladies and gentlemen, about our trading systems that these moving averages they come with the market makers template. You don't even need to set your moving averages. Obviously, There's a video on how to set up your market maker template, so you'll be able to customize your template, change colors and the thicknesses and whatnot. But you don't need, when you have the template, you don't need anything else. You just need to use a template accordingly, according to my specifics. Then you'll be able to, use it properly, and then make sure that whatever that you do yields out very good returns, and then you're consistent, and you make it very simple. You own it, because the point is to make it simple and own it. Understand? So let me just conclude this section. I believe we're done with exponential and moving averages. So right now we're gonna go into Fibonacci. We're gonna look at Fibonacci retracements and extensions. So let me just take a quick break. So coming back to the Fibonacci retracements and extensions, I just want to show you my golden Fibonacci retracements and extensions, ladies and gentlemen. Like as you see, it's the 38.2, the 50%, and the 61.8, and then extensions are 127, 141, and 168. So without wasting time, let's go to our charts. So uh, in terms of Fibonacci, I'm very precise and clear. I only trade the Fibonacci, golden Fibonacci retracements and extensions. So my golden retracements are 38, 50, and 618. Understand? So let me just okay, let me check out my Fibonacci expansion, how that looks. I don't have it there, which means it doesn't look very good, but it's cool. Let me just go to 30 minutes, 1 hour. Yeah, let's use the 1 hour. 30 minutes. Yeah, yeah, let's use the 30 minutes. So like I said, the 38%, 50%, and the 618. So let me just draw that real quick. You know what? Actually, let me just use the Fibonacci expansion. I think that is much better. Okay, let me just, where is that? There it is. Insert. Yeah, there it goes. So I'm just gonna do that. There's the 100%. So I'm just gonna edit that real quick. So the 618. 0. Uh, 38.2, 38.2, 0.50, 50.0, 0.618, 61.8, and let's go further up. Let's see what we have up there. We have only 161, so we're gonna have to enter 1.41, then you had 141.0, and then it's 1.27, it's 127.0, and there we go. So I have my Fibonacci expansions there. That's my 100%. So I want to be taking positions along this area, so 38, the 50, and the 618. So let me just do that real quick. Yeah, I think it's good. So if I take a position here on 38%, let me just look for one that is very precise. Yeah, I'm just gonna put it there. Yeah, I think this is proper. So this is from X, this is A, B, C, D. So I want to take my positions between the 618, the 50%, and the 38.2. So this is what I want you to take note. If the price comes to 38.2, then we're gonna take that our target and 127, or actually the 618, because this is supposed to be the 618. This is the 50%, and then this is the 38.2. So from 38 from 618, we go to 127. From 50%, we go to 141, and from 38.2, we go to let me just put that back there. We go to 161. So let me change that color into green to illustrate that it's going up. Yeah, so that's how it goes. And then let me just put the red line to show that it's a reversal. So let's just say you've noticed that we are expecting a reversal from this area here. You wait for a retracement for a 56 for 38 50% or 618, and then this is where you would take your positions. You understand? And then you should know, you don't just, if you don't, because these are my golden Fibonacci retracements. So let me just do that in color. Yeah, this is my golden Fibonacci retracement. I wanna trade from these levels, and then if I take a position anywhere in these levels there between the 38, 50, and 618, this is the areas. Okay, let me just remove that. If I take a position there, this is other areas that I'll be looking to take my targets. Just gonna change that color into light gray color. So there we go, ladies and gentlemen. I take a position 50%, taking my target at 141. Take a position at 618, taking my target 127. 38.2 to 161. 38 to 161. 50 to 141. Let me just also do that. Yeah, there you go. From 38 to 161. From 50 to 141. From 618 to 127. Understand? So, but for you to take a position first, you will look at the retracement. Let me just remove that. Look at the retracement. You got the 50% there, or the 50 or 38% retracement. So now you wanna take a long position. So what you do, you wait for that 3 and 13 moving average crossover. There it is. After seeing this, then you take a position. What date was this? This was 2nd of November, and then okay, let me just 31st of November, the 29th, the 30th, the 31st, first, the 2nd, and the 5th. So this was Friday. Understand? This was Friday. It's in line with the trend. So this was basically Friday, the midweek reversal. 1, 2, 3, 4, 5. Monday, Tuesday, Wednesday, Thursday, Friday. So you took a position here because it's on that 800 moving average, in line with an uptrend on that 50% retracement, and you have that 13 and 3 and 13 first moving average crossover. You take a position and then you take it long. That's how I do my Fibonacci retracements and extensions and retracements. So let's look for one last example on another pair, pound dollar. Yeah, going south from here. So let me just remove all that. So remember, I take the 50 and the 618, the 38% 50 and 618, 38% 50 and 618. So let me also remove that. That's my Fibonacci. There it is. So when I look at this retracement here, and then this one as well from that high, from that one there. There's nothing much there. We'll just trade from this, from because of this moving average crossovers, and then there's also like not crossovers, this uh trend moving average crossover. So we don't have any significant retracement there. This one, you have the 23.6, and that was the 38.2. So after taking this 38.2, I know my target is 127. So from here, my target is gonna be, okay, let me just use the expansion. Actually here, yeah. So this is the 38.2, this is the 50% 618. From 38%, my target is 127. And then from 50%, my target is 141. And then from 618, my target is 161. Take my targets there, and then I wait for another retracement. So now that I've entered here, and then I took my targets, let's remove that. Look into the following day. Fibonacci from the previous high to the low. We got another 38.2. 38.2 from there. We look into taking another target at no, this is not 38.2, it's actually 618. From 618 to 127. First target. Uh, Second target, and the third target at 127, at 161 rather. You see that? It's a very good setup, you said. So Fibonacci is also very good. And then remember, when you spot a Fibonacci, good Fibonacci retracement, that is in line with the trend. And then you just wait for your confirmations, like your trend 18 moving average crossover, because that's the first crossover that we get before we can, before the price, really continues and with whatever trend, whatever direction that it was going towards. So in this case, what do we have? We only have 50%. So you get a nice 50% retracement from this low. Price from this high, it went down here. From then on, it rallied, it ranged. So when it's ranging like this, we expect the price to give us a stop at high, to stop out people that sold and put their stop losses at just 25 to 50 pips above the size. So after having noticing there's also a 200 moving average crossover, moving average bounce there. So that's our entry area. So we're gonna look into taking short positions because it's between the 50 and the 618, and the 38.2. So let's just draw those lines again. From 50%, our target is 141, and then from 618, our target is 161. Did it hit our 161? Yeah, just by a pip, just by a mere pip. So let me just zoom it in. Let's see. Yeah, just by a mere pip right there. You understand? So that's how you go on about it. So I believe with regards to let me just go back to the slides. With regards to the Fibonacci, I hope we clear. You don't just trade any Fibonacci retracement on extension. You need to be precise as to where to make your entries and when to take your targets. So, like I said, from 618 to 127, from 50% to 141, from 38.2 to 161. So I guess we go with that. So right now we're gonna do the TDI, the average daily, week, and the weekly ranges, and the work time we know to GMT. So TDI. Let's get into TDI. Um, I have some work here. Okay. Okay, let me just pause that for a second. Okay, so for TDI, we're gonna look at the three major things: the market sentiment, which is the market baseline. We're gonna look at the overbought and oversold conditions, which we use the price line and the signal line, the green and the red lines, and also gonna look for divergences and convergences. So without wasting time, let's get into it. I already have some work that I've done on TDI, so let me just go to the actual work. Okay, not this one. You know why not this one? Because this is counter trending. It's going against the trend. As you can see, the moving averages are going up, and then this is a Tuesday stop on tie. So instead of taking the short position against the trend, that's not it. So I would encourage this one because you can see the trend is going up. The moving averages are pointing upwards. You can see they're coming from 200. It's a little bit looking upwards. But then the main thing is here. It's the Thursday midweek reversal. You understand? It's Friday actually. So we expect the price to reverse here. But the most important thing is here. What do we have here? Do we have oversold conditions on the TDI. So when it's oversold, which means the price is trading below or not below on the 37, between the 37 and the 32, or a little bit below. For me to say that a market is oversold, it should be trading below the 37 support and the 32 support lines. You understand? In between or below. But anything over it is not really, oversold for me. I need to have a very good, precise oversold or overbought conditions. So that's an oversold condition right there. What else do we have? We have a shark fin. Here's a shark fin low. It's a shark fin because we have a sharp move of the price line on the downside, and then it comes back and crosses with that signal line. So we have the crossover with the signal and the price line. Remember the price line is the RSI line. It represents whatever that we see here. So each and every single move that's here, it's the price line, that is that green RSI line, and there's the signal line. So when you see a crossover happening between the price and the signal line, you know that's a very good entry signal right there. So what else do we have? Uh, we have a lower squeeze now. We don't have that, but it says market baseline, price line, signal line, and upper volatility band trading below the 50 line. So okay, this is what I'm referring to here. You see how this upper volatility blue line, it's trading below the 50 line. The 50 line is the line that is that thin line that cuts off the above part and the lower part. Meaning, if everything is below this line, it's oversold, uh, or it's just negative market sentiment. You understand? So this is how it goes. We have three things here. We have oversold conditions. We have shark fin low. It's not really much blood in water because I prefer my blood in water to be this the signal line to touch the whether it's the upper or the lower volatility. Then I would say that's a blood in water. This is blood in water because it's like red in blue. So that is how I explain my blood in water. But for now, there's no blood in water here. So that's what we can only see with regards to this. You Now you can see, like, because of I said it's in line with the trend, so we're trading in line with the trend. We've seen how the moving averages have crossed over there. We see it's a W formation low. We see it's a Friday midweek reversal. And what else is the New York and it's London and the New York session. We also have TDI there. We have oversold conditions. We have what do you call this, price and signal line crossover, and then we also have shark fin low. So that's a good thing there. The other thing that what we have also in this one, it's obviously we're not looking at market makers, but then we're not gonna trade TDI without looking at market makers. So what we have here, we had on Monday, we have divergence. Look at that big divergence there, because they diverge. That is going up and this is going down to signify that the market has no momentum of going up. The sellers are committing more positions as opposed to buyers committing more positions, taking it long. So there are more sellers as opposed to buyers. As you can see, the market is moving momentum here before we can see it on the chart. So otherwise, with this divergence, you could have been able to take a position here on Monday, knowing that it's the last month of the week. It's the last week of the month, and it's potentially the high price of the month, and it's Monday. So if you don't have the courage to take it, rather wait for a proper Tuesday stop and know that it's proper time to counter trend. Plus, we're also seeing this reversal candlesticks there. We have dojis. If ever, if it's not doji, it has to be what do you call this, to the tops. Yeah. So what else do we have here? We have the divergence. First, we have is it a shark fin high? No, it's not really. But we also have another divergence here. If you can look here, the price is going up, and then here it's going down to signify that this is an exact area where the price is will now start to reverse. So you see how this shows us like this divergence here, it's going down and here it's going up. It signifies that around this area here the price is about to retrace, but within this day you also need to get that precise entry area. So we're going to look at within that day, or we can see we also have a smaller divergence there, a shark fin high and a divergence. That shark fin high there was during the London Open. This evening star was the London Open. You understand? So it issued another pin there on New York Open. So to just stop the ones that already had short positions, and then the price, went down. So after trend 13 moving, after not trend 13, what am I saying? So after that, price and signal lights cross over, then you know it's right now it's about time. So when you start seeing this, and then the price is giving us this shooting star, you take a positions there and then you kill it. You understand? And then the following day is the same thing. Now that the price, look at what happened. You got the trend 13 moving average crossover, the price went down. And then it's like everything crossed over. Trend 13, it's like trend 13 and 13 and 15, 15, 200, but it's not the moving average, just this ones. So it's the price and signal line, and then after the price, signal, and the market baseline. The following day, price comes back, comes to retest that crossover. You see how we had a crossover here, and then price came back and retested that crossover. That's a huge sign of a sell there. We had a sharp fin high, and then look at what the price line is doing. It retests that market baseline. This market baseline is very important. This MPL, this yellow line. So after that, you get another crossover between the price and signal line. You re-enter again because you took another position here. You re-enter again here. Understand? So let's move to another one. Um, okay, this was the first week of the month. This was March. I think it was 2016 or 17. So why are we buying here? Because it's Friday midweek reversal, and then obviously as you can see, you have a harmonic pattern that is completing right there, and then this is potentially lowest price of the month, but then definitely lowest price of the week. We have half a Batman. You have an ear. There's our ear there, and then what else do we have? It's London Open stop and low. So we're good with our market makers and technicals. Right now, let's go to TDI. So what do we have on TDI? We have what we call a lower squeeze, and we also have oversold conditions. So for me, this is extremely oversold because the price line is the market baseline, the price line, and the signal lines, and both the volatility bands are really squeezed below or just near that 32, 37, and 32 support line. So for me, that's a huge red flag. So I'm gonna need to wait and properly look at this. When I see something like this, then I know it's a lower squeeze. So a lower squeeze, it's when all these lines are squeezed on the bottom side. So when they're like this, you're gonna get a sharp move to the upside. If they are squeezed on the upside, we call it an upper squeeze. Then you're gonna have a really sharp move to the downside. So when you see the squeeze to the downside like that, you should expect an up movement. If they are squeezed on the upside, you should expect a downside movement. So uh, there it is. What do we have? Do we have divergence? No, we don't have any kind of divergence there. We only have the sort of a very shallow what do you call this shark fin, a very shallow shark fin to the downside, and then the signal the price and the signal line crossover, first crossover, and the market baseline crossover. So after this, then when it's confirmed like this, having crossed over all of them like that, it's the same thing as 50, 200, and 800 moving average crossover. So when they crossed over like that on your shorts, and then you see another crossover there on your TDI, then you know it's a very good entry area. Also given that this is potentially the lowest price, and you can see how much this went upwards from this point. So basically this was the lowest price of the month. You understand? So what else do we have? It's almost the same. It's exactly the same thing over and over and over and over. So the other reason, like as I said on the other video, that it's not like we don't trade Mondays. We do trade Monday. The only time we trade Mondays is when you have a valid, completed, high probability pattern, maybe like a category two or a category three pattern. You understand? Then you know it's a high probability paying pattern. When you get there, you kill it. You understand? So this was a very good one to start with. Let's look at the market makers. This was obviously Monday, the accumulation phase, but then there's also like a harmonic pattern that completes there, but it's not written here. It's a harmonic pattern that's completing here. Before we go to Tuesday, we're only looking at this. So we're looking at there, and then you see this divergence on the TDI there to start with, and then secondly there's a shark fin high on that New York Open. It's not New York Open, it's New York session. But then with just that divergence there, it's very crucial. We can now see that the price is going down because it's now late in Monday, the last session of the day. So and then there's a harmonic pattern that's completing there. And then this is also the last week of the month, as you can see. So we're expecting a reversal because this is the last week of the month. So each and every like on the last session of the day you expect the reversal, on the last 2 days of the week you expect the reversal, on the last week of the month you expect the reversal. You understand? So this was also the case. We are expecting a mid-month reversal. You understand? So divergence, we good. We take a small position, wait for Tuesday, Wednesday. In London we don't get anything, we relax. New York Open, we look at our TDI. Okay, what's happening right now? In terms of technicals, we had left shoulder ahead and the right shoulder. And I look at this right shoulder. The right shoulder is not able to take that left shoulder, and then it's also not able to take out that high. So which means the market doesn't have any momentum going up. And look at how the TDI is pointing downwards. And then look at this also, this high squeeze. So basically, what we're seeing, it's I don't know how to put it, overboard, very overboard conditions. Yeah, I think that's how I should put it. And then too much positive market sentiment. The market baseline is, for me personally, if ever it's overboard, it needs to be between 63 and 68. But then if it crosses above 68, then I know it's way overboard. I'm expecting a reversal very soon. Market baseline doesn't doesn't overextend itself a lot like that. You understand? It moves within 63 and 37, moves somewhere between here. But then when it's like this, and then it's an upper squeeze like that, and you already got that on Friday, then my friend, I'm telling you, you kill it. You kill it when it comes back like this. There's a crossover, first crossover, and then crossover of the market baseline. It comes back, it retests that crossover like 15, 200 moving average crossover, and then price coming in back and retesting 200 moving average. It is exactly the same thing. It's just that in this case, we're looking at it on a small scale. You understand? So moving average coming to crossover. You see that crossover there. First crossover, second crossover. Price comes below, comes and reaches that crossover. The support comes back and resistance, then goes below. You kill it. Right there, right there. You enter. You take it short first. When it comes here, you know it's level 2 safety trade, level 1 safety trade on the TDI, level 2 safety trade on the TDI. Then right, this is a home run. You kill it. After this, it's a confirmed entry. Price signal and price and signal line crossover right on top of that market baseline. So it's a very huge sell right there. So continuing, another one here is Monday. This is the best one because we have a W formation low on the TDI. We also have, and it's Tuesday. Remember, it's Tuesday. You have a W formation low which is in line with the trend because the moving average are pointing upwards. You also have divergence there, a small divergence. Look at the left leg. It's higher than it's a little higher. The right leg is lower than the right leg, but on TDI it's totally the opposite. So what we have is a shark fin low on that New York Open. Remember, London didn't get anything, but come New York, if you don't get anything on London, you wait for New York. Then come New York, we get that beautiful W formation low, which gives us nice divergence on the TDI, and then it's oversold conditions because you can see how the price line is trading on that 37 support line. So it's not extremely overbought conditions, oversold conditions rather, but then it's good enough for me to conclude that this is an oversold condition type of setup. So 30, not 30, what you call that, price and signal line crossover. I take a position, goes up, I'm good. Next day I re-enter. crossover. We didn't have that moving average crossover, not moving average, price and signal length crossover coming back and retesting that same crossover there, because it's not really visible, and it's a little bit far. You understand? So for me, that's a very good setup there. What else do we have? We have divergence here. This is actually, yeah, this is divergence as well. So yeah, man, it's more or less the same thing over and over and over and over and over. We look for the same thing. Like you are very precise and specific. You only trade certain things on certain days. You don't just walk into a chart and be like, you know what you're looking for at what time, at what day. That is how easy it is. You understand? So I struggle to understand why people confuse themselves and then stay away from counter trending. If you wanna be a successful trader, stay away from counter trending. So this was also a very good high probability setup because it was Tuesday stop and right on top of that moving average 200 on 1 hour. So you see how this is 200 moving average bounce on 1 hour. So automatically I know on 15 minutes it's an 800 moving average bounce. On 4 hours it's 50 moving average bounce. So right here, there are three moving averages that are bouncing here, right there, by just looking at this chart, flash card, with 200 moving average on 1 hour. So automatically on 15 minutes it's 800, and then on 4 hours it's 50. So we have a nice high probability pattern there, and we also have a bullish engulfing. On TDI we have shark fin low, we have price and signal lines crossover, and then we don't have very oversold conditions, but then we do have level 1 safety trade, because why? We have a 15 200 moving average crossover. Moving right along. What happened here? Okay. So yeah, man, that's it. In terms of, let's go back to our slides. So the TDI, we've seen the divergence. I don't trade much convergence, because convergence is continuation of the trend, and then divergence is the reversal. So I don't look much at convergence. I have a lot of things that I look for, but then convergence, maybe you can do it and show it to us. So we've seen how the market sentiment, market baseline, translate some info to us as to when to enter short or long, which one is extremely overbought, oversold. You know, I look at overbought and oversold conditions, but then when the market is oversold, it's extremely overbought or extremely oversold. That's when I look at the market sentiment, like the market baseline. To confirm that the market is extremely overbought, I will look at where the market baseline is trading. Is it trading above the let me see what is it trading above the 63 and the 68? You see this for me, it's extremely overbought conditions. Why? Because the market baseline is trading above the 68 line, and there's also major divergence there. And then what else do we have? You have divergence. We had shark fin highs there, and then you see this crossover. What happened here? There was a crossover there, price and signal lines, and then also the market baseline. And what it did, it came back, retested that crossover the price line, but then there's still huge major divergence there. So from here onwards, the price is gonna take a huge dip, and then there's also an upper squeeze. You understand? So you should also it's just that I didn't put it in here. Let me just go back to those slides. So there should also be like a squeeze, like an upper squeeze and a lower squeeze, because that's also a very high probability setup. That if you see a squeeze that is on the upside or on the downside, which is squeezed together above the 38 or the 67 support and resistance lines, then there's a very good setup. So we're just gonna do the ADR, AWR, and then work time auto GMT. So the ADR and the weekly price range. Let's just go to our chart. Let me just remove everything there. Starting with my let's remove that. The TDI is actually very simple. Oh, you know what? Let me just go to this the American dollar. Yeah. So this is an ADR high. This is an ADR low. For me to take a short position, If ever this ADR high, if ever price comes to these levels and also give issues as a pin on that ADR high, I take it, I don't leave it. Let me show you something real quick. Yeah, so this is what I want to show you. You don't just use ADR on its own. You use it with confluence of other things. As you can see here, this I was expecting this the first week or the second week. Or this was Friday. As you can see, this was the third. The third was Friday, and this was Monday accumulation. Tuesday stop hunt. So I was expecting stop hunts, but then my stop hunts I wasn't expecting a stop hunt low. I was expecting a stop hunt high, then drop. Understand? So I didn't get a stop and high on London. So if I didn't get on London, I need to wait for New York. I waited for New York. It came here. So at that precisely at that time between 2:30 and 4, I took that short position. Why? It was Tuesday stop and high. It was on that ATR high. This was potentially the lowest, the highest price of the day, because the highest price of the week was established the previous day, and you can see how close was that previous day high there. So I knew this area was a high value area that I should start looking to take the short positions, and I did, and then specifically because it was that ATR high there. So give it that ATR high, and then trigger positions, short position, and it fell. As you can see, it's New York reversal, it's Tuesday stop hunt high, it's high price of day, it's ATR high, vector 3 candles signifying a stop hunt. There's an outside structure stop hunt because those highs are just above that new Asian session highs. It's a head and shoulders pattern, left shoulder, the head and the right shoulder. It spikes to the high there. There's an evening star and then railroad tracks there. Guess what? There's divergence on the TDI. Where do we have the divergence? There it is. It's going up there, but then it's going down, signifying that the market has lost momentum of continuing with an uptrend. There's blood in water. Do we have blood in water? Yeah, we do. Now we have blood in water. This is blood in water. You know why? Because the signal line is trading on top of the upper volatility band. So this upper volatility band is supposed to be blue in color. So when the blue goes into red, it's blood in water. So we have shark fin high, we have blood in water, we have uh, uh, crossover between the price and the signal lines. We have overbought conditions here. Understand? This is overbought conditions, and then what else do we have? Yeah, that's it. Let's look at another one. The same thing. It was Tuesday, Monday accumulation, Tuesday stop and low. Because you can see this was the third, it was Friday, Monday, Tuesday stop and low, London stop and then didn't go anywhere. New York open, price flight. It I don't know if I say okay, it's cool. Let me just not get into that. But then as you can see, it was a very nice buy here with lowest possible risk, having price touched that ATR low. As you can see, you have everything there. You can just go through it. Another one there it is there, and then so an ADR. This is a Mona Lisa for me. This was the best. That is why I like the dollar across the board, because it gives us those nice runs. So imagine having taken that position at 2, 4, 6, 8, 10. So it's like two it's like five 2 meaningless positions with 165 uh, uh, peps. So I'm just gonna calculate how much was that in terms of in monetary value. Two times 165. It's 100 330. Yeah, it's 330. 330, 369, 12, 15, 15, that's 150, 1650. So we made about $1,650 from here to there in like I don't know how long, because we took these positions around the first touch, second touch. This was a very beautiful one. As you can see, it's a stop and low, vector 3 candles, and then it's an outside structure, market make outside structure, stop hunt. There's potentially the lowest price of the month. It's the second week. It's the first week, but then it's Tuesday. Remember, so it's actually the second week, because the first week was the third. On Friday was the third. So that was the first week. This was the second week. Second week of February 2016 or 2017. I'm just not sure. We took a long position, gave us a nice Tuesday stop and low. Gave it's a Brinks trade. It's a Brinks trade, like as Steve would say, Brinks trade on that ADR low, and then New York Open issued us with railroad tracks. You can see we have some beautiful morning star formations there, and then some rejection signals there. So we take it high within within 4 or 5 hours. We already accumulated more than 700 and 360. It's 765 dollars, 765 pips in just one day. You understand? So you just need to use them in confluence. That is how you use the ATR. So when it comes to average weekly range, let's go to the charts. You don't get that. You don't get the average weekly range. You just need to be able to calculate it yourself. So what I do is that I would just draw my weekly cycles like that, from the highest to the low. From the highest to the low. No, actually, let me just show you something real quick. Where's that document? Let me just open that document. Okay, let me just put it in here. I just want to show you something real quick. So you can calculate any range, whether it's weekly range or whether it's monthly range. So what you would do, you would count your how many pips is it from. Let's start from January here, from this low price to that high price. Maybe it's like you bought here in big one. How many pips did we make from that high, or it's actually from here until there at the top. So but then it's cool. So from this high to that low, let's just say it's 300 pips. It's 300 pips, and then from that high, from this low to that high is 280. From this low it's 150. From that high to this low is maybe 450. So you just add them together. 350 plus 280 plus 180 plus 450. They would give you maybe like 1800 pips. 1800, then you divide it by 4, then you get the average weekly range on this pair. I don't just do it with a 1 month. I would just add like 3 months or 4 months with adding just weekly ranges from the high to the low. I would just calculate for how much is it from here to there, and I'll write for 335. Then I'll write them for like four weeks or 4 months or 5 months, and then I will just calculate that, and then I will then get my average weekly range. Then I know if I take a stop and low here. If it's gold, then any pair that I take if I take a stop and low on Tuesday, I know on average I have to get like 300 pip 100 pip movement. So which means minimum that I have to get on one position on average has to be 300 pips if I take it from stop and high to reversal on Friday. That's how you know how many pips is it left from level 1, how many pips potentially could it be until level 2, because you also have the average daily range, you have the average weekly range, and you can, when you have the average daily range, you can calculate yourself average weekly range and the average monthly range. It's very important for you to have these numbers. It's your numbers, it's not mine. These are my numbers, so you have to create your own numbers, you understand, so that you'll be able to see even on a bad week or on a bad month how many positions on average do you win, how many positions do you lose, and on average how much do you make, and so forth. You understand? I have my statistics. These are my numbers. You have to create your own numbers. As you can see, man, these are very consistent. When you enter here, you hold because you know it's the second week of the month. You're gonna make how many monthly range is 659. So from this low to that high, it's 659 pips. So imagine if you enter five positions here, you enter five here, you enter five here, you enter five here, you enter five here. You're gonna make like 10,000 pips and become a millionaire like 1 year. So I'm not saying you don't use proper equity risk management. It is proper risk management and equity management. It's just that people, they don't know when to buy or sell and how long to hold. That is why they are not able to hold positions for a long time. Like as I'm saying right now, I've been holding some positions for a few months, from since October, November, December. I'm still holding some positions right now, and I've been trading. I haven't been trading for a few weeks now. You understand? Here's another one. You buy there, you buy there, you buy there. You collect 720 pips from this trade. 720 here, 650 here, 530 here. Altogether, it's like 4,500 pips. You got paid. Multiply by standard lots. It's how much? $45,000. $45,000 multiplied, converted to South African rand is how much? 3 quarters of a million. Yeah, I think it's around about that. 700,000 rands. Yeah. So it's the same thing over and over and over and over. The same thing that I'm showing to you right now. It's the same things that I've been doing for the past five, 3, 4, 5 years. You understand? So As you can see, what I mentioned that on NFP Friday first week, it's either we get a midweek reversal or a Friday NFP reversal. Here it is right here. This was NFP. We got that NFP pin, and then voila, price rallied. As people, I'm surprised people say, "Hey, NFP, we trade NFP." I'm like, you will get banned. So these are my numbers. On average, when it comes to the gold, I know this was 2017. I collected 33,000 peps with how many positions? 77. And then on average, I collect 625 peps per trade. Average monthly, no, this is the average monthly range. So on average, gold moves 600 peps from the lowest price to the lowest to the highest price. You understand? And then average weekly range is 300 pips. So from the lowest price to the highest price. Lowest price meaning Tuesday stop hunt until the highest price, which is the Thursday Friday reversal. You should have a minimum of 295 pips. So if you're able to enter at that lowest possible, uh, with that lowest possible risk, you would be able to get a very good risk reward, because if you take you with lowest possible risk, you will risk about 50 pips minimum, maximum, and then look at this reward. It's like 1 to 6, so that's a very good risk reward. So guys, we've been doing this for years, man. It's experience. These things where you just need to have a proper, version, or not version, a proper way of analyzing and make it work for you. Own it. You understand? So let's go back to the slides before I can just finally conclude this section here, indicator section. So the work time Novoto GMT, it's an intraday trading session indicator which shows us the Asian, which displays or colors, uh, has a color coding when the Asian session is in play, the London and the New York sessions. So, but then I guess you already know that because it's the first thing that you see when using the market makers template. So I'm just gonna put that in. Let me just go to a different currency pair. So I'm just gonna put that in here. No time auto GMT. There it is. So this is simple, guys. Look at what I use. For me, if you living in a different time zone, maybe you would use this work time, or maybe just the GMT offset. Just work between GMT offset, work time, and no auto GMT. Then you'll be able to find your exact time zones. So for me, I use the in South African time. I use the work time no auto GMT. That is my time. Understand? So this is the Asian session. It's color coded. This is the beginning of the London session between of us. The Asian session starts at 12 o'clock midnight, ends at 7 o'clock in the morning. So you'll be able to say it for me, because this indicator will draw all this for you. Beginning of London Open, you'll get a shadow box where it will signify you where to take your where the stop hands are most likely to occur. As you can see here, between of course 8 and 10. I didn't draw this. The template that does this. You will see London Open, and then later in the New York session, New York Open later in the afternoon between half past 8, half past 2, and 4 o'clock. So this is what it does. Otherwise, if you want to use uh, what do you call this, more indicators, market makers indicators, just make sure that you just scan them through, because when you put it in like that market makers template, it's like this, and then these are not my time zone, so I need to take it back and then make sure that it's on my exact time zones. This is it, you understand? This is my times. So it's very easy and straightforward. You just need to change that real quick. It's aqua, not tail, pale turquoise. It's aqua. Let me change the thickness, put it to level 2 and that. And basically that is how you also customize your template. So this is it. Let me just remove what I don't use. Pivots, I don't like them, I don't use them. And then let me also remove work time auto GMT. And then day high lows, it's this one. I also don't use it because for me personally it works sometimes, so I'll put it on when I want to use it. So you can see it's very nice and clean, it's straightforward. That is how you customize your market makers template. You understand? So you're good to go. So I believe We've covered everything that we need to know in terms of moving averages, Fibonacci, TDI, and then average daily and weekly ranges, and then the work time auto GMT, no auto GMT indicator. So thank you, ladies and gentlemen. And then the next chapter is it's high probability trading currency setups, entries, exits, and confluences. This is where it gets late. So stay tuned.